Are we in the midst of a banking crisis? Can it possibly be worse than what we saw in 2008? Well, heck, if you listen to the media, you can go absolutely crazy and insane with worry. You want to know the truth and how to protect your hard-earned dollars? Well, then stay tuned to this week's episode of the Retirement Income Source, where it's always all about the income. And welcome to this week's episode of the Retirement Income Source, where it truly is all about the retirement income. I'm David Scranton. I'm here with my good friend and co-host, Sarah Samuels. And today we're here to talk to you about all things banks, all things banking related. Are we in a banking crisis? And if so, what you can do about it. Which banks should you consider? Which banks should you stay away from? And most importantly, how and when you should be using banks versus other financial instruments.
Well, Dave, it's great to be here with you, of course, and with all of our listeners and our YouTube viewers out there. And I think this topic of banks and investing in banks is really timely with what's going on. And like you mentioned, if you only listen to the media, you're going to go crazy with worry because from what they're saying, it's 2008 all over again. It's all over. It's doom and gloom constantly. It's a lot of problems, you know.
So let's go to real grassroots. You know, what are we seeing in the real world? So did you get a chance to get into a branch of a bank sometime in the last week? And if so, was there a run on the bank or people taking massive withdrawals? What did you see when you were in the bank?
Yeah. Well, I got to be honest with you, Dave. I don't think I've actually been in the bank physically since I set up my checking account probably when I was about 15 years old or so. I do all of my banking on the mobile app for the most part. So you should try it. Yeah.
The mobile app?
The mobile app. You know, you download it on the phone. They got it for iPhone, Android, everything.
You know, my assistant likes to take checks that come into the office. She takes a picture of the check and deposits a picture.
Oh, yeah.
I never knew you could deposit photographs. I've got photographs that I've built in albums for my entire life. If I could deposit those and they're worth something, maybe I should do that.
Well, I know about the cashing the check. I actually used to do that too. It's just so much easier than having to run to the ATM. But yeah, Dave, I think you got to get with the 2023, right? It's the 21st century.
There you go.
App
You're doing it again. You're doing it again. You're making me feel old, Sarah. Darn it.
I'm sorry, Dave. Well, you know, I don't mean to do it. You know, you're not old. You're just, you know, getting older, a little thinking about these different things. But Dave, you know, no conversation about banks is really complete, I think, without mentioning what happened with the Federal Reserve earlier this week, where they, in spite of this so-called banking crisis, they actually raised the interest rates by 0.25 percentage point. So what do you make of all of this, Dave?
Well, I think there is some real fear. Obviously, 3 banks failed, so that's saying something. And the Federal Reserve had to make a decision here. Do we not raise rates to keep, and later on the show, we'll talk about how the Fed's raising of rates in large part almost completely caused these failures, right?
Right.
So now do they stop? Do they reverse course? Or do they stay with their plan? And I think they want to stop, maybe even reverse course, but they need to save face. I think if they didn't raise rates this time, Sarah, they'd actually would have maybe spooked the financial markets thinking, oh my goodness, this is a real issue. And they don't want to spook the financial markets. They want things to be calm. So I think they had to follow through. But I suspect that after this, at the next FOMC meeting, I think we'll see a pause on rate hikes. And who knows, before the end of the year, we might actually see rates drop back down again. So
yeah. Well, getting back into the banking crisis, our first Ask Dave question here is from Kim out in California. And this is really the $1 million question. She says, Kim, yep.
Is this my neighbor?
She might be.
I've got a neighbor down here in Florida. They have a place in Rancho Santa Fe.
Oh, you know what? Maybe they're a listener of the show,
Dave.
Kim. Could be Kim.
Ah.
Well, Kim wrote in and they said, how do I know which bank is safe and where should I put my money?
Well, Kim, the question really depends on your situation, but I would say the only way to know that your bank is safe is to stay within the FDIC insurance limits. Because if you exceed those, there's always a chance for failure. Now, right now, we're hearing about the problems with the regional banks. Supposedly, the big banks are somewhat immune from it, and I say somewhat. But at the end of the day, the only way you can know for sure that you're safe is staying within the FDIC insurance limits. Now, there are some ways to do that. You know, if you're a bigger depositor, you might think, oh my goodness, I've got $5 million at $250,000 a pop. Do I need to have 20 different banks? Well, not necessarily. If you understand the rules, and I don't understand them completely, but for example, if you're married, it's my understanding you can set up an account with $250. Your husband could set up an account with $250. You can have a joint account with $250. And because they're all titled differently, Those three accounts could be in the same bank and have 750,000 worth of FDIC insurance. And there's some other things you could do even beyond that. So it's not like you necessarily have to go to 20 different banks. You just need to be careful on the titling. But yes, if you're a big depositor, you may have to go to several banks. But I would take that extra step because you can never be too secure. You know, if you think about it, Sarah, the reason that somebody like Kim is in the bank is because they want safety. Maybe they want liquidity also, but they definitely want safety. And I think the only way to really know you have that is to be within those FDIC limits.
Yeah, well, that makes sense, Dave. And Kim, thank you so much for sending in your question. If any of our other listeners or viewers out there have a question that you want Dave to answer, send me an email at askdave@retirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with the host of the show and my good friend Dave Scranton. Today, we're trying to demystify the banking thing, right? The banking, the so-called banking crisis, as we're calling it. So we're trying to actually get to the bottom of it here and give you the information that's going to be most helpful for you, so you can make decisions about where you want to invest your money. So, Dave, we just heard a question from Kim, one of our Ask Dave questions, asking which bank was safe. I know there's a theory that, of course, the big banks are safer, but besides the FDIC insurance, what are some of the other reasons that big banks appear to be safer to the average person?
Well, first of all, the FDIC insurance, at least for Silicon Valley Bank, was guaranteed above the 250. So all depositors, you could have $1 billion in the bank and it's covered, right?
Right.
So now there's this implicit FDIC insurance with all banks. But to me, if it's my money, implicit isn't good enough. I want explicit. I want somebody to say, you're insured with no cap, right? So to answer your question, though, I think the first thing to need to understand is why this happened with these regional banks. Well, it happened for two major reasons. Number one, you got to realize how banks make money. Banks make money by paying depositors a lower rate of interest and lending it out at a higher rate, right? And they get the spread. They call it a net interest margin. And that's why we've talked a lot, Sarah, on recent shows about how this thing called a flat yield curve, when short-term and long-term interest rates are equal or similar, is a terrible thing for banks, because it means if they're paying depositors the same amount of interest that they're receiving when they lend the money out, it's impossible for banks to make money. So banks have been getting squeezed over the last 18 months because of that.
Yeah.
That's the first problem. The second problem is that we know that when interest rates go up, the value of bonds drop. The market value of a bond drops. Well, mortgages are really like a bond. So when interest rates go up, the value of a mortgage drops, or a car loan drops, right? So now if you have a run on the bank and the bank has to go ahead and liquidate all those loans to pay depositors back, guess what? They're out of trouble. They're out of luck. They're in trouble because now they've got to sell those things at a loss. And all of a sudden, whatever reserves they have boom, they disappear like that. So the advantage that bigger banks have, to get to your question, is bigger banks have different profit centers. Okay, bigger banks have investment centers, right? You walk in, there's the investment guy there that talks to you, or investment gal, so you get a different profit margin. Some big banks actually do investment banking, where they do initial public offerings, right?
Yeah.
That's another thing. A lot of large banks have trading departments. They make money on their own proprietary trading. So they have different profit centers that help dilute this problem that I just described. The regional banks don't have all that. So therefore, they're more directly and more immediately affected by this raise in interest rates. But Sarah, when we come back, I want to share one more thing that may shock a lot of our listeners, and that is, what if I told you that if you take the FDIC insurance out of the picture, that banks are actually riskier than a bond mutual fund, something that you might think is harmless. Banks can be riskier than a bond mutual fund. To find out why, stay tuned. I'm David Scranton, here with Sarah Samuels, and this is the Retirement Income Source, where, it truly is all about the retirement income.
You're listening to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, here with Dave Scranton, and thank you for spending your weekend with us here as we kind of demystify everything the media is talking about with the so-called banking crisis. Dave's here today, and he's going to tell you really how to invest in banks, where to invest in banks, and answer some questions from our Ask Dave listeners, all about the bank. So, Dave, just a few minutes ago, you were teasing us here, telling us, hey, if you took out the FDIC, if you remove them from the equation, then investing in banks can actually be riskier than bond mutual funds. And that's surprising to me to hear you say that, because I know how much you dislike bond mutual
Right,
funds.
right.
So you got to tell us, how can it be riskier, and how do our listeners avoid that?
Well, banks have, as we saw with Silicon Valley Bank, banks have some of the same issues, right? A mortgage, again, is just like a bond, right? A bond is when you're lending money to a corporation, and a mortgage is when you're lending money to an individual.
Right.
And if it's at a fixed rate of interest, the payback is at a fixed rate of interest, then when interest rates go up, the existing bond or the existing loan becomes worth less if you need to resell it. Why? Because the person who's buying it from you can go out and issue a new loan or buy a new bond at a higher interest rate, right? So they're going to want to pay less for your lower performing bond, your lower performing loan. So with individual bonds, we always say the reason we love individual bonds for people who want to be conservative, who are retired, who want income, is because you have two important guarantees. You have a guaranteed interest payment, a fixed interest payment for the life of the bond. And when the bond matures, you know you're going to get the full face value repaid.
Right. Yep.
In the middle, I mean, it might be worth more, it might be worth less. You don't know, but if you can hold it to maturity, you know exactly what you're going to get, assuming there's no default.
Right. It's almost a guarantee. That's why it's so much safer.
That's right, assuming there's no default. Now,
Right.
remember that. I'm
That's
going to
the
get back to
tricky
that
part,
in a minute.
right.
Get back to that in a minute. So now you take the loans. Well, the same thing is true in the bank, right? If you take the FDIC out and there's a run on the bank, like we said, there's two concerns that cause this banking crisis. One is that the profits for banks, the net interest margin, has been squeezed because as the difference between long-term and short-term rates have gotten compressed, they can't really lend it out at a much higher of an interest rate than they're paying a depositor, right? So that hurts them. They can't build the reserves as much. But moreover, when there's a run on the bank, then all of a sudden they got to have to go ahead and liquidate those loans at a loss. So just like with the bond fund, you know, I had a good friend one time, his name is Mike, who's an actuary. And if you ever met actuaries, you know actuaries are pretty smart people. So this guy kind of surprised me.
They're a lot of fun at parties, right?
Yeah, exactly. This guy said to me one time, you know, I think bond funds are like a stock. And I thought this is either going to be the most brilliant comment or the most ridiculous comment. It ended up being the most brilliant comment because he said to me, he said, whenever I invest in something, the value of which is determined by the actions of other investors, I consider that to be a stock. And what he meant was that he could go into a bond fund and he can say, I'm going to stay there, I'm going to hold the course because, you know, I know interest rates are up, I know the value of the bonds are down, I'm going to stay there, I'm not going to sell. But guess what? If the other people who own that fund panic and sell, that fund manager must sell those bonds and realize the loss. And now poor Mike over here, the actuary, loses money even though he tried to be a good soldier and not panic and sell.
So he's relying on all the people in the group, kind of. If they panic, then he loses out.
And that's what happened if you think of like SVB Bank and some of the others, is that once there was a run on the bank, if you were the good soldier who said, I'm not going to panic and sell now that these loans are worth less, well, guess what? You were playing musical chairs, and you were the one stuck without a chair.
Right.
Everyone who came in and rushed to take their withdrawals, they got their money back. You didn't.
Well,
so that's why they're you know, really as risky as a bond fund. But in a moment, I want to also address the default risk, and the default risk tells you why they might be riskier than an actual bond fund.
Yeah. Well, speaking of bond funds, Dave, and bonds in general, our next Ask Dave actually has to do with the interest rates being higher on bonds right now. So we have Daniel from Tennessee. He says, I know interest rates on bonds are higher now, but wouldn't a 4% on a CD at an FDIC insured bank be a better investment?
Okay, so Daniel, I think where you're coming from is maybe corporate bonds right now you can get mid-5s, maybe 6 if you know where to look. And heck, if you can get 4.5 FDIC insured, why not take it, right? Well, the answer is it depends upon your goal. And we're going to talk about this later in the show, Daniel, so I hope you stick around for the whole show. You know, if you're driving, you're heading in the grocery store or something, you know, maybe you could kill some time in the car before you walk in, because I don't want you to miss this. So if you're retired or close to retirement and you're trying to maximize your income, then buying a CD right now might fix the problem short term, but it's not going to fix the problem long term. Why? Because those 4 to 5% interest rates you're only getting on short term CDs. You're not getting them on long term CDs. So Why? Because the banks know that rates are going to come back down again, and now maybe sooner rather than later. So if you want to fix the income need long term for your impending retirement, then you want to get into more things like bonds and so on, so you can lock in that higher interest rate for longer. Okay. So when do the banks make sense? Well, Dan, if you're saying, well, I want to buy something in 3 years or 5 years, maybe a vacation home, maybe a boat, maybe an RV. So I need that money to be protected. Then buying the CD makes sense, because then you're looking at 3 to 5 years actually cashing it out, and you want to get as much interest as you can, but you also want to protect your principal. So if you're purely trying to get more income, I don't think it's necessarily the best play. The bonds might make more sense. But if you're trying to protect your money in general for a near-term purpose, that, Daniel, is when you use bank CDs.
Yep. Well, Daniel, thank you for sending us your Ask Dave question. And if any of our listeners or viewers out there want Dave to answer one of your questions, maybe about the banks or about your retirement in general, all you have to do is email us at askdave@retirementincomesource.com. Thank you for listening to the Retirement Income Source, where it truly is all about the income. We appreciate you spending some time with us this weekend. My name is Sarah Samuels. I'm here with Dave Scranton, the host of the show, of course. And Dave, today we're talking about the banks. We're talking about different investments and different ways to invest in banks. So just before the Ask Dave question, you were talking a little bit about default risk,
Right.
and why that's an issue. Can you explain?
So if you take the FDIC out of the picture, the bank is like a big bond fund. It has a bunch of loans. If there's a bunch of requests
Everyone
for
has
withdrawals,
to trust each other. If someone pulls out,
right.
it could be a big issue for everyone
well,
involved.
it's like flying in formation. If there's 5 pilots flying in formation, we all have to trust that if everybody's going to turn right, we all do it at the same time, or we're going to have a midair collision, right? It's not going to be
Big
pretty.
problem. Right.
So you have to trust that everyone does it and nobody flinches, right? And that's the problem, because when it comes to money, everybody's out for themselves. So they're going to play based upon their own rules. So it's like a big bond fund, because the bank can't necessarily hold those loans to maturity any more than a bond fund manager can hold the bonds to maturity. But the default risk is even worse. Think about it this way, okay? Let's just say you have somebody who works for, I'm going to name it, let's say you work for Tesla.
Okay.
Somebody works for Tesla. I'm throwing out a name. I don't know why I chose Tesla. Now, if you're an investor, you might buy a bond in Tesla. You might loan money to Elon Musk so that he can do all the wonderful things that he does, right? Now, if you're a banker, though, you're not going to be lending money to Elon Musk. You're going to be lending money to you as an employee of Tesla, right? So that you can have a car loan, you can have a mortgage on your house, right? So the bank's going to be lending money to the average employee that works for the company. An investor who buys the bond is lending money to the company.
Okay.
So all of a sudden, the economy gets tough, and the profit margins of the company, in this case Tesla, get squeezed. Does Elon Musk want to default on his debt, yes or no?
No.
No. So he's going to cut expenses any way possible, including laying off employees. So now, all of a sudden, you get unemployment benefits, which are a lot less than what you're earning before, and all of a sudden you might have a tough time making your mortgage payment or making your car payment, right? So now you might be in a situation where you default to your bank long before Elon Musk defaults to the bondholders. And only once he's laid off 3/4 of the workforce, there's nobody left. And all of a sudden, it gets to bare bones, now he might default to that bondholder. But until then, there's been a lot of carnage with people who've lost jobs, who've had trouble paying their own personal bills, and that's going to affect the banks before it affects the bondholders. So I would argue that there's more default risk with the bank if you take the FDIC insurance out of the picture, and that's why, in many ways, without that FDIC insurance, banks are like one big bond fund, only they're riskier than bond funds.
Yeah. Well, it makes sense to me, Dave, especially your Tesla example, and Elon Musk, in your example, like you said, is going to do everything in his power to avoid having to default on paying out on
I
the
should have used
bond.
Twitter, since that's where he laid everyone off, but oh well.
Yeah, that might have been a better example than Tesla. Yeah. So, all right. So how do you know when you should use the banks versus other investments, and really depending on what stage of your retirement you're in? Well, Dave is going to explain coming up on the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels here with Dave Scranton. We'll be right back. Welcome back to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels here with Dave Scranton, and today's show is all about the banks, how to invest in the banks, where to invest, and really demystifying this whole so-called banking crisis that the media is trying to stir up. So, Dave, how do you know when it's a good time to invest in the banks versus the other alternatives out there? We kind of touched on this a little earlier with Daniel in our Ask Dave question.
Mm-hmm.
You mentioned why it might be a good idea to invest in CDs, but explain again. I think that was a great point you made.
Yeah, Daniel was thinking about it more in terms of, where interest rates are now and where the sweet spot is and where
Making more money,
where the better
basically.
deals are. That's right. But the first thing you need to think about is what is the purpose of this money, right? Because we don't invest money just to make oodles and oodles of money. It's not like a contact sport, right? It's not like, gee, I could build my net worth up and then I go next door, I knock on my neighbor's door, and I hold my balance sheet up against the window, go, ha ha, I'm worth more than you, right? That's not the purpose of
It's probably
investing.
not the best way to do it, right?
That's right. So you've got to think about what is that purpose, okay? Is it to maximize income now or in the future because you're going to be retired? Is it because you're going to be making a purchase in a reasonably short term and you want to protect that money? Or is it just maximizing for money that you might spend 10 or 20 years from now? Because obviously, over the long run, the stock market outperforms everything else, right?
Yep.
Yeah.
That's just kind of a given, right?
But the problem is when you look long run, you really have to go 15 or 20 years. A lot of people say 10 years, but you look at that, we always talk about 2000 through 2010. If you were in the S&P 500, the general stock market during that time, you actually lost money from 2000 to 2010. So you'd really have to have 15 or 20 years. Okay, so if you're young, you're not going to retire for a long time, that's great. If you're going to make a purchase, but it's going to be, gee, I want to buy a beach home when I retire, and that's 20 years from now, great. Okay, or you got grandchildren that are just born, you want to save for college. Okay, great, stock market, right, long term. But if it's something you're going to do shorter than that, then you've really got to think about either balancing that portfolio out by integrating some bonds, because sometimes bonds zig while stocks zag, right? Let's say if you have
diversifying, right?
Right. So let's say you want to buy something 10 years out. So now you've got to take some of that risk out of the stocks by integrating some bonds and diversifying in different asset classes. But if you want to buy something, let's say in the next 5 years, that's really where the bank CDs come in.
Okay.
Because now everything in a 5-year period is really up for grabs in terms of how volatile it's going to be and what it's going to be worth 5 years from now. Anybody who tells you they could predict what an asset or asset class is going to be worth in 5 years is nuts. So you really have to say, okay, that's what the banks are for. Let me get the highest interest rate I can over the next 5 years, and let me go from there.
Yeah.
That's where banks come in, again, if you want to buy an RV or you want to buy a boat or you want to buy another house, right? Or maybe even just if you want an emergency fund, but you want to earn more than
if you want
savings.
a credit card, right? Or if you need a savings account, you got to go to the bank. I mean, a lot of places are going completely cashless, but that's a whole different story, right? A lot of places you can pay with your phone now, Dave. I don't know if you know about that, but you can actually pay with your iPhone now.
Sure. Yeah, and I know we were having some fun earlier, but some self-deprecating humor on my part. But yeah, I'd pay my bills online too, honestly, and so you could do a lot with that, the mobile apps today. But, it's for emergency funds. And you might even decide, okay, I want my emergency fund in CD to get that 4% that Daniel wanted, right? Knowing that, gosh, if I have a longer-term CD and I bail out after, let's say, a few months, that my penalty is only going to be 3 months' worth of interest in many cases. So my penalty might not be that bad. Yeah. But as we'll talk about in a moment, if your goal is to maximize income because you're retired or you're going to retire in 10 years, then you're not solving the problem long-term by being in a CD, because long-term CDs don't pay 4% today. Short-term CDs do. And that's where you've got to go to this universe of bonds and bond-like instruments that, of course, we'll continue to talk about throughout today's show.
Yeah. Well, Dave, I think a lot of people out there, maybe some of our listeners and our YouTube viewers even feel this way. I think a lot of people are just kind of giving up on the banks. And our next question, our Ask Dave question from Stephanie in Nevada, kind of deals with this topic. So she says that I have a friend, he does hard money lending. He actually gets nearly 10% on the hard money lending. Is that a good idea?
Well, Stephanie, if you're willing to turn into Vito the loan shark, if something goes wrong, it can work.
That's what it sounds like. But.
So, it's the old risk versus reward. If something sounds too good to be true, it could be. And the reality is the gentleman Stephanie, might have a great track record of getting repaid. But if somebody's got to borrow money from you at that rate of interest when they can get it cheaper in a bank, then you've got to question why. Why are they willing to pay that? And it's probably because their credit is not that great. Now, you can make loans that have more risk. This is what people might do with corporations if they invest in junk bonds, right?
Right.
But if you're going to invest in a portfolio of junk bonds, you want to be diversified across dozens and dozens of companies. And if you're doing hard money lending as an individual, Stephanie, you probably don't have enough money to diversify to make 20, 30, 40 different loans. So if you make 2 or 3 and one defaults, well, now that's a half or a third of your money that could go down the drain. So you've got to be you got to have enough to diversify in different hard lending programs to do it the right way. And you've got to be a good credit analyst. You've got to be able to dig down and look at the financials as a credit analyst in a bank would, and have enough knowledge to be able to say, okay, is this person credit worthy for me to make this loan? Maybe there's some other reason they're not willing to go to the bank, but they're really credit worthy.
Yeah. Well, Dave, I just made the connection. Stephanie is in Nevada, and there is some organized crime in Nevada. Maybe Stephanie's friend has some ties. Maybe I'm not sure, but
a little laundering of the moolah is what
that's how they get
yeah.
the 10% back. He's got a good repayment rate
okay,
out
maybe.
there.
I don't know.
I don't know. Stephanie, thank you though for sending in your question about hard money lending. And if any of our other listeners or YouTube viewers out there have a question you want Dave to answer, just send me an email at askdave@retirementincomesource. That's SOURCE.com. And thank you for listening to our show today, The Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels, and I'm here with the host, David Scranton, as we talk about the banking industry as a whole, the so-called banking crisis, and really where our listeners and our viewers out there, where they should invest and what they should do. So, Dave, we just talked a little bit about hard money lending. Now, what about families? You know, they want to do the banking without the banking, right? Like the son calls up dad and says, hey, I'm thinking about doing this, buying a house or starting a business, and I need some money. What do you think about that, Dave?
Well, it's interesting because the bank is a middleman.
Yeah.
And, really, you wonder why, okay, I'm putting money in, I might be getting 2%. My kids go take a loan, they're paying 7%. Where's the other 5% go? The other 5% goes to, and those margins are squeezed. That net interest margin is squeezed now because of short and long-term rates being close together. But the point is, whatever that margin is goes into the bank's hands. Well, how do you bypass that? Well, you can make an intra-family loan where you split the difference and say, okay, I'll lend you money at 4.5%. I make double what I was going to make, and you get a 1/3 discount from what you were going to pay. Now, of course, the key with this is that you've got to be willing. You've got to decide how you want to handle this. If you're going to put a lien on a property, let's say to write a mortgage for a son or daughter, how important is this money to you? What if they default? What are you going to do? Are you going to foreclose on the property like a bank would and get your money back? If so, you've got to make those terms clear. Or is it a wink, wink, don't ask, don't tell? Hey, it's my little girl. If she has problems, I don't need the money. I'm going to let her keep it. It's not a big deal. So you've got to get that squared away first, because the last thing you want to do is try to save a couple dollars, Sarah, with a bank by bypassing the middleman, and now all of a sudden you've ruined an entire family dynamic. So if you can get past that and understand what the rules of engagement are, then yeah, you can certainly cut out that middleman. It's called disintermediation. Disintermediation, which is a true financial term, been around for a while. And disintermediation is being more and more common these days with the issues of banks.
Yeah. Well, I always kind of bought into the philosophy, if you loan money to your friends or family, it's not a loan, it's a gift, and you really shouldn't expect to see that money back. But hey, maybe if you write it up like you said, Dave, and you really are acting like a bank with a lien on a property, something to make it more legit, or you just kind of shrug your shoulders and say, it was a gift for the kids.
Yeah, mom, look, mom and dad are retired. We need this money. We need the income. If you can't pay it, we love you very much, but the bank would foreclose. So we're going to do the same thing because we need the money.
Yeah.
Because think about it, and this is where I talked about purpose-based investing before. Remember, you have to say, what am I trying to do? Am I trying to get total return for a purchase 15 or 20 years from now? Total return for a purchase 5 years from now? Or am I trying to get income? Because if you're trying to get maximum return for income, like we always talk about in the show, you really don't care what happens to the lump sum. If I've got $1 million and I need $50,000 a year of income, if the $1 million goes up to 1.3 million, I really don't care if I'm getting my 50,000 of income, because I can't sell it, because if I sell it, I won't get the income, right? Conversely, if it drops to 700,000, I really don't care either, because I'm still getting my 50,000 of income, right? So if you're an income-based investor, you're retired or within 10 years of retirement, now, banks aren't the answer. It's the universe, as I always talk about, a universe of income-generating options. You want maximum return for income, not maximum total return, maximum return for income.
Right. Well, banks aren't always the answer, especially for investors out there that might have more money than your average investor. So, what do affluent investors do when they need money, Dave, and why they don't always borrow from the banks? We're going to cover that in just a minute.
Yeah, we are. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it truly is always about the retirement income. And welcome back to the Retirement Income Source, where it truly is all about the retirement income. I'm David Scranton here with Sarah Samuels, and today we're talking about all things banks. How to know whether your bank is secure, how to know which banks to look out for, when to use a bank, when not to use a bank. And we talked just for a moment about the Fed's quarter-point interest rate increase, but Sarah, it seems like with everything going on with the banks, that's kind of just not really a newsworthy item today, is it?
Right. Yeah. No one really seems to be talking about that, especially with all the banking thing going on. The so-called, like we've said, banking crisis, right?
So-called crisis.
So-called crisis. Yeah. But Dave, just a few minutes ago, we were talking about wealthy investors and why they don't borrow from the banks. So fill us in here. Where do wealthier, more affluent investors go to if they want to borrow money?
And before I answer that, I want to just put closure on one topic that I kind of ran out of time with a little bit.
Yeah.
And I can't stress enough this concept of knowing what the purpose of a particular chunk of money is going to be, right? Because if the purpose of this money is to make a lump sum purchase down the road, you're concerned about total return. You're concerned about how much money you could make when factoring both income, interest and dividends, and growth and capital appreciation, right? Remember that formula we always talk about, Sarah, TR equals I plus G. Total return equals income plus growth. But if you're retired or planning for retirement within the next 10 years and your goal is to maximize income, then you care first about the I, first about the amount of interest and dividends. And then after that, you care about getting some growth in addition to it. But that's a second issue. So like Dan from Tennessee, right? Talked about whether buying a bond at 6% or a CD at 4%.
Versus a CD at 4%, right?
Well, I mean, that sounds like a big difference when you say it that way, but when you're retired, 6% gives you 50% more retirement income than 4% does. Put another way, you have $1 million, instead of getting 40 grand of interest, you get 60. That's 50% more. That's a big deal.
Yeah, that's pretty good deal there. So, all right, Dave. So now let's get back to my original question.
Okay, sorry.
Our listeners and our YouTube viewers,
little ADD, squirrel.
They're hanging in there, and they want to know, how do the wealthy live, right? Like we love to look at the magazines in the supermarket telling us all about celebrities. They're just like us, but they're really not. They invest differently than we do. People that have a lot of money. So, Dave, tell us, how do they borrow? Where do they go to borrow money?
Well, a lot of people, cannot put a lot of average folks put most of their money in 401ks and IRAs. It's tax deferred. It's great. But there are limits on how much you could put in. So if you're an affluent investor, you have a lot more cash flow. You might be maxing out those things, but most of your money is going to be in what's called non-qualified accounts. So you might have stock accounts, bond accounts, brokerage accounts that are not tax deferred. They're in regular taxable accounts. Well, those accounts you can actually borrow against. So, for example, you've got $5 million sitting in a brokerage account, you can borrow a couple $1 million against it. It's usually a pretty competitive interest rate. It's interest only, so you don't have to pay back any principal, just interest only. And the interest is deductible against the income from your investments. So if you're smart and you're invested for the I, even if you're in stocks, but you're invested in high dividend stocks, the strategy is to say, I want to earn enough dividends on my portfolio to pay for the interest on that margin loan. So essentially, I pay interest only. My dividends are covering the interest. The tax deduction from the interest is washing out the taxation on the dividends. And it doesn't cost me anything out of pocket to get this cash. And I don't have to pay any capital gains tax by selling anything.
Pretty good deal.
Yeah. Now, there's caveats we have to talk about later in the show about that. But that's one way that affluent investors utilize things. The other way is life insurance. Life insurance cash values can be leveraged in a very tax-effective manner. I know I myself have made many purchases in my life by leveraging my life insurance policies, then paying the loan back. And again, that's typically an interest-only payment. So again, I don't have a big payment schedule where I have to pay back principal and installments, because that gets a little bit restrictive, right? That's a problem. And the other thing that a lot of affluent individuals do is real estate. And the reason they love real estate is because you can borrow against real estate. Now, there's lots of reasons: tax efficient, tax benefits, depreciation, but also you can borrow against it. So a lot of affluent individuals will use real estate for that reason.
Yeah, and there's a lot of reasons too why real estate is not always a great investment, but we'll talk about that more in a second. For right now, I want to get to our Ask Dave question. So we have John out in Wyoming. He says, Dave, I'm afraid to borrow against my accounts because I remember hearing about margin calls back in 2008. Is this a valid concern? So Dave, margin calls, can you explain that?
Yeah, it is a valid concern. I did say there were some caveats, things you have to be careful of when you're borrowing against a securities account, and that's the margin call. You know, if there's a maximum amount that you can borrow, and in part that maximum depends upon who you are and who holds your account. But if you borrow against the maximum, and then the value of the underlying stocks and bonds drops in value by too much, you may get a margin call, which means you've got 3 days to write a check to pay back some of that loan. And if you don't, they're going to sell the stocks and bonds to pay off the loan. Now, you know, stocks and bonds are down in value. Is that when you want to be selling things?
Nope, you're going to lose money.
That's right. So you want to be careful. You want to make sure you only borrow enough that you leave a buffer in there so that if we have a significant drop, you still won't get a margin call. Or if you do get a margin call, now maybe you have that cash value life insurance that you can borrow from to pay that off. Or maybe you have a line of credit on a piece of real estate to buy it to pay it off. So again, yes, it's a great tool for an affluent investor with a large non-qualified brokerage account, but you've got to be careful. Don't overdo it. Too much leverage, too much debt in any case is always a bad thing.
Don't over leverage yourself. That's always great advice. So John, thank you so much for sending in your Ask Dave question. And if you have questions out there, Dave has answers for you all about retirement, income investing, even about the so-called banking crisis. So if you have a question, please send us an email at askdave@retirementincomesource.com. And thank you for listening to the Retirement Income Source, where it truly is all about the income. I'm Sarah Samuels. I'm here with Dave Scranton, and it's been a very chock-full show. Lots of information.
But we're not done yet.
We're not done yet, though. No. In fact, Dave, I want to get right into why real estate might not always be a great investment. A lot of financial gurus and commentators out there are always pitching real estate and why you should invest. But tell us why it might not be the best investment.
Well, first of all, you can over leverage real estate just like you can over leverage your stock and bond account, right? And then if the values drop, now you're upside down. But I think what you're referring to is that a lot of affluent individuals don't want to borrow against their homes. In fact, a lot of them don't even own homes. They want to rent, right?
In fact, Grant Cardone, I think, is one of them. He won't own anything that doesn't make him money, I think. So he doesn't own a home.
Who's a big real estate investor right down here in southern Florida. That's right.
Yep.
So, but investment property is different because investment property, you can get cash flow from it, so you get income. Remember that income. Wealthy investors love income, right? Even if they're not that close to retirement, because cash flow affords you a lot of flexibility in life, right? So you get income, and then you get to depreciate it, which means you get tax write-offs against the income. When you go to sell it down the road, you get capital gains treatments, and also you can leverage it. Okay? But with your primary home, it's not quite the same way. You can't depreciate it. You don't get tax benefits. You don't get any income from it. And if you think about if you were to maxi mortgage a home, you'd say, well, the mortgage payments that I pay, gosh, I could probably rent the same place for the same cash flow, maybe less cash flow than the mortgage payment. And so take my house, for example, right? I bought my house in the financial crisis in 2008, right? So I had good timing. It's worth double that right now. But if you
bought when prices were low and now it's gone up, right?
Right. But if you double your money on an investment in 15 years, that's an internal rate of return of less than 5%. But wait a minute. I had to pay property taxes along the way. I didn't have to pay property taxes on my stock accounts or anything else. Now I've got to replace my air conditioning units. That's $26,000.
Don't forget about the roof, Dave. You got to pay for that too, that upkeep, right?
Not yet, but that's going to happen, yeah. Eventually my pool, another 5 years I'm to redo it. That's God knows how much, maybe 50, 100 grand, right? So your primary house has upkeep that you don't have to deal with if you're a renter. So when you do the math, I hate to say it, but a lot of times if you take out the pride of ownership, a lot of times renting actually is a better deal financially because you know what your costs are. They're finite. And heck, you're not getting a lot of the tax benefits by owning anyway, so why own? And the Trump administration really limited the amount of mortgage debt and the amount of property tax you can deduct. So that argument is even stronger now for somebody like a Grant Cardone who says, I want to own a ton of real estate, but only as an investment, not my primary residence.
Right. Well, bottom line, Dave, what's your best advice for our listeners and our viewers out there as they're dealing with what's going on and they're watching the news and they're worried? What's your best advice?
My best advice is, look, don't panic. Stay educated. Yeah, listen to the news, stay informed, but realize that the media's job is to blow things out of proportion. It's the shock effects that people want to watch, people want to listen, people want to read, right? So take it all in, but then try to find, as Paul Harvey used to say, the rest of the story, right? And also, hey, listen to the Retirement Income Source so that you can stay informed on a regular basis here.
Well, you can always get the full story with us. You know that. So if you want to listen to any of our shows, or if you want to maybe send it to your friends or family, you can always go to retirementincomesourceradio.com and listen to all of our past episodes.
Yeah, that's great. And hey, we appreciate it if you share that also with your friends and family. Most importantly, thank you for joining us this week, and we hope you join us again next week. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it truly is all about the retirement income.